Good afternoon. Here are the closing market comments for Friday, June 24th. Grain markets rallied early this morning, but mostly favorable weather forecast at midday for the majority of the Corn Belt did pressure prices into the close. July corn finished 10.5 cents lower at $6.70. New crop December corn down 14 cents at $6.32. July soybeans up 2.5 cents at $13.20 and a quarter. New crop November beans down 8 cents at $13.09 and a quarter. Kansas City July wheat down 11.5 cents at $7.48 and a half. And Minneapolis July wheat down 18 cents, finishing at $8.26. The outside markets were relatively quiet today, somewhat mixed. Crude oil currently 18 cents a barrel higher at $91.20. The gold market $18 per ounce lower at $1,502. U.S. dollar index up 27 points at 76.17. And the stock market down 99 points, with the Dow currently trading at 11,950. Livestock markets were mixed, with August cattle up 47 cents, finishing at $113.20, while the August hogs were down 90 cents, closing at 95 even. Taking a look at our weekly price summary, July corn futures for the week down 30 cents. July soybean futures for the week down 13 cents. And for the week, July Kansas City wheat futures down 56 cents. I want to take a few minutes to discuss the outside market influences here today. Outside markets were choppy and mixed, providing very little influence on today's grain trade. The outside market trends have been primarily supportive since last summer, but some of those long-term trends have either turned or showing signs of turning at this time. This may explain why the funds have been liquidating grain ownership in their long positions despite the mostly positive fundamentals for grains. Let's review a few of the outside market charts, beginning with crude oil, and we can see that crude oil has been in a long-term uptrend since last summer, and at this time it appears that crude oil may be in the process of trying to break out of that long-term trend to the downside. There hasn't been a clean breakout of the trend, but nonetheless, chart watchers are very carefully watching crude oil to see if it does in fact break out to the downside. Turning to the gold chart, the gold market has been in a long-term uptrend. In fact, over the last 4 to 5 months, it's been in even a sharper uptrend. And it does appear, especially following today's weaker trade, that gold may be in the process of trying to break out to the downside from its longer-term uptrending line. Taking a look at the stock market, the Dow Jones Industrial Average, this chart also has been in a long-term uptrend since last summer, and over the last couple of weeks here during the month of June, we've actually broken through that upward trending line, and again, causing concern overall for investors, and likely causing some investors to reduce exposure in all markets. Next, let's take a look at the U.S. dollar index. That index has been in a downtrend, a very consistent downtrend since last summer. Overall, a cheaper U.S. dollar is considered very friendly for grains, as a cheaper U.S. dollar makes U.S. grains more affordable or cheaper on the world market. And at this time, it appears that the U.S. dollar may be in the process of breaking out of that long-term downtrend. We can see over the last week or so that it's been challenging that overhead resistance. And in addition, the lows posted in early June were not able to take out the lows that were posted back in early May. And this may be another reason why the commodity funds in general have been in liquidation mode in grains over the last couple of weeks. And finally, let's take a look at the commodity index. That's a basket that includes metals, energies, grains, and other agricultural products. After posting highs at 688 in March, taking out the highs of the commodity index back in the year 2008, the market has been unable to take out those highs over the last 3 or 4 months, and in fact, the lows continue to be progressively lower. So the overall trend in the commodity index has established, at least in the short run, an overall downtrend. And again, another reason for concern for the overall commodity funds, and possibly giving reason as to why they've been liquidating their positions in the grain markets. Turning to weather news, the weather remains mostly favorable for the corn and bean belt, at least at this time. Warming temperatures and scattered rains are seen as beneficial for crop development. There is some ridging in the forecast for next week, and that needs to be monitored very carefully. At this time, the longer-term weather maps are indicating that any significant heat or dryness will only last for 4 to 6 days. The status of this developing high-pressure ridge will be very important to price direction Sunday night and into Monday's trade. Taking a look at the July corn chart, today's trade was very interesting in that we had very strong prices this morning, followed by a very weak close. Overall, the lows that were posted yesterday morning at 6:39 in the July contract are going to be very important chart points as we move into next week's trade. Despite today's weaker close, we're still over 30 cents from the lows posted yesterday morning, and the technical indicators still showing signs of turning to the upside. Despite today's weaker close, prices are still 30 cents above the lows posted yesterday morning, and the technical indicators still showing signs of trying to turn to the upside. Therefore, today's price action from both a chart and a technical standpoint not giving us any major signals of a significant move in either direction. Overall, our opinion is that corn has likely overdone it to the downside here in the short run, and next week, heading into Thursday's government reports, we believe that this market could consolidate and even work a little bit higher into those reports coming up next week on Thursday. But we do have to respect the fact that we've traded below all of our moving averages and that we have major overhead resistance coming in the 720 to 740 type price range. And so unless we can get some bullish news, whether it comes from the weather or it comes from the government report, we're likely to find pretty major selling if the market does in fact rally up into that low to mid $7 range. Turning to the July soybean chart, soybeans having also somewhat of a mixed day today, trading on either side of unchanged and finishing just slightly higher in the July contract. Today's close was 28 cents above yesterday's low, so yesterday's low still seems to be somewhat of a significant chart point, and the technical indicator is still showing signs that it may want to try to turn upward. The chart has turned lower in soybeans over the last 3 weeks or so, but the rebound from yesterday's low and closing slightly higher today, giving us a sign that we may see some additional upward bounce here next week heading into the June 30th government reports. Our opinion in the soybeans is that yesterday's lows at 12.92 may have overdone it to the downside, at least in the short run, and we could rally back here over the course of the next few days, maybe of a week or so. But we don't want to get overly bullish at this time due to the fact that we have broken through all of our major moving averages, and all of those moving averages are now pointed downward. Therefore, the market is likely to find some pretty significant selling if we can bounce into that 1350 to 1370 price range. And it may take some additional bullish news, something new in the marketplace to break through that overhead resistance. We won't rule out at this time a bounce back towards the $14 price range. But again, it may take some additional bullish input for that to happen. And at least for the moment, the weather forecast looks mostly favorable. Taking a look at the Kansas City July wheat chart, this chart is in a very sharp downtrend over the last 3 to 4 weeks, but we have fallen over $2.20 in that time frame. Technical indicators are now very oversold, nearly pegged at zero. So this type of environment can create a very sharp corrective bounce, but we do want to make a note that the moving averages are pointed lower, and so we may see quite a bit of overhead selling if this market can bounce back into that $8 to $8.50 price range over the next few weeks. Overall, we believe that this wheat market is very likely to see some bounces from the very, very oversold levels that we're at right now, but we do want to make note that the overall trend has turned down. So we'll have to very carefully evaluate making some additional sales if this market can, in fact, rally into that 8 to 8.50 price range, and there's no additional bullish news to support a further rally from that point. That'll wrap up this afternoon's broadcast. Thanks for joining us, and have a good weekend.